All right, let's really dig into something today. It might sound a bit like accountants speak at first glance, but it's actually crucial for understanding how businesses really make money. We're talking about revenue recognition, specifically step two of the ASC 606 process. Now, for those maybe less deep in the standards, ASC 606 is that core framework for how companies report revenue. And today, our focus is squarely on identifying performance obligations. This one, well, it often turns out to be one of the trickiest parts for companies in the real world. But our goal here is to make it crystal clear for you. Because getting this right, it impacts pretty much everything. You know how a company prices things? One can actually recognize that revenue on its books. It's fundamental. Before we dive deeper, though, just a quick reminder. This deep dive is based on material from Farhat lectures. All the content, the examples, explanations we discuss, it's all derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe a CPA candidate, or already a professional, definitely visit the website. They've got additional practice questions, video lectures, detailed support, really good stuff to reinforce today's topic. And a special thanks to Professor Farhat for providing this valuable material. Okay, so let's start right at the beginning. This term, performance obligation, what exactly is it, like at its most basic level?
Right. At its core, a performance obligation is, well, it's essentially a promise. It's a promise a company makes to you, the customer, a promise to provide or transfer a specific good or service. You can think of it as what the company needs to do or maybe what they're expected to deliver. But here's the really crucial part. For that promise to count as a separate performance obligation, the good or service involved has to be distinct.
Okay, distinct. That sounds like the key word here, the linchpin maybe, but I get the feeling there's probably a lot packed into that one word. What makes something truly distinct versus just, a component part?
That's a great point because distinct is really where a lot of the judgment comes in. It's not always black and white. So a product or service is distinct if you, the customer, can benefit from it on its own. Or maybe not entirely on its own, but you could benefit from it using other resources that are readily available to you. Essentially, it needs to be useful to you as a standalone item. It can't just be an incomplete piece of something bigger.
Right, like a puzzle piece without the rest of the puzzle. Not much use.
Exactly. So this raises the big question. How do we actually know if something meets that distinct criteria?
Well, there are a few indicators we look for. Typically, a distinct product is something the company sells separately. That's a big one. It's usually not integrated with other goods and services in a way that makes it useless by itself. It's not highly interdependent, meaning you can still get value from it even if it's not combined with something else the company's selling you in that contract. Often you'll see competitors selling something similar separately, and generally it's just available in the market as its own item.
Okay, so if it can stand alone, it's not intrinsically tied to something else in that specific deal, and you can get value from it right then and there.
Hmm.
It's distinct. But it makes me think about the other side. What isn't considered distinct? Where do things fail that test? Yeah, that's just as important. And there are a couple of main scenarios where something typically isn't distinct. The first one is when goods or services are highly interdependent or interrelated. This means they're so intertwined that one is basically useless without the other in the context of the contract, or they significantly modify each other. Let's use a really simple example. Think about getting a vanilla chai from, say, Wawa or your local coffee shop. That chai is made of milk, tea, spices, right?
Sure.
Now, could you benefit from just the milk or just the spices separately as part of buying that chai?
No, not really. You're buying the finished drink.
Exactly. They are inseparable components of the final product, which is the distinct item, the vanilla chai itself. So the company wouldn't account for the milk and the spices as separate performance obligations within that chai. The customer isn't buying them individually for independent use there.
Right, okay. That makes total sense for ingredients. You're buying the chai experience. But what if I grab that chai and an egg sandwich at the same time? Are those separate? Or does buying them together somehow bundle them?
Ah, good question. No, in that case, the vanilla chai and the egg sandwich are definitely two distinct products. You can enjoy each one separately. The coffee shop sells them separately. They might be sold together, but they aren't interdependent like the chai's ingredients were.
Okay, got it. So interdependence is key for that first category of not distinct. What's the other main scenario?
The second big one is when a company bundles several goods or services, even if they can be distinct on their own, into what the contract defines as a single combined output or product. Think about hiring a construction company to build you a house. The whole thing from A to Z, as they say.
Wow.
They'll do the foundation, the framing, the wiring, plumbing, roofing. All these steps involve services or materials that, sure, could be sold separately. A plumber sells plumbing services, right? But if your contract is for one single price for the final completed home, then you, the customer, aren't buying distinct products at each stage like foundation, then walls, then roof.
Mm.
You're buying the finished house. That whole project becomes one performance obligation. Because think about it, you can't really use the foundation without the walls or the wiring without the roof being finished. It's all part of that single integrated product promised in the contract.
Ah, okay, so the contract itself is really powerful here. It can define things as one combined item, even if the pieces could technically be separated. But what happens if the contract does break things out, even if they seem related, like they list separate prices or deliverables?
Right, and that's where it gets even more nuanced. A contract can absolutely create multiple performance obligations, even for closely related items. It often comes down to whether those items identified in the contract are separately identifiable, and if the customer can benefit from them independently. Let's take another example. Imagine you hire a company, let's call it Maze Inc., to build a website for your business. And the contract clearly specifies 4 deliverables. 1, design the website. 2, build the website based on the design. 3, provide training for your team. And 4, offer ongoing maintenance and support for a year.
Okay, seems pretty standard for a website project.
Right. Now, let's say Maze Inc.
Mm-hmm.
also sells these services separately. Like you could just hire them for design work or just for training. And crucially, you, the customer, could actually benefit from these things independently. For instance, you could take the design from Maze Inc. and hire a different company to do the build.
I see. So you could use just the design part.
Exactly. If that's the case, they're sold standalone, and you can benefit from them separately. Then each of those 4 items represents a distinct performance obligation. Even though they're all related to the website, the way the contract is structured and the nature of the services allows for separate value and use for you at each step.
Wow. Okay, so comparing the house and the website, the crucial difference boils down to how the contract is written and whether you, the customer, can actually get independent value from each piece along the way. That's a real aha moment there.
Precisely. It highlights how important the specific facts and circumstances, especially the contract terms, are. Let's maybe look at one more common scenario just to really nail this down. Buying a new car.
Okay.
Let's say you buy a Toyota RAV4, and as part of the deal, you get a 1-year free subscription to their SOS button service for emergencies. Are these 1 or 2 performance obligations?
Well, a car works without the SOS button, and I guess they probably sell the SOS service separately after the first year.
You got it. Those are 2 distinct products or performance obligations. You can definitely enjoy and use the car without the SOS system active. They aren't interrelated in terms of the car's main function. And yes, that SOS service is typically sold separately on a subscription basis after the free period. However, think about the car's battery or the tires. Are those distinct from the car itself?
No way. The car doesn't work without them. You can't drive off with just the tires and say you got value.
Exactly. Those are integral components, not distinct performance obligations separate from the car itself.
It really sounds like, in practice, this involves making some pretty significant judgment calls based on all these criteria. I can see why you said it's one of the most challenging steps.
It absolutely is. It requires careful analysis of the contract, the nature of the goods or services, and the business's practices, like whether they sell things separately.
How do companies manage that? Ensuring consistency, especially in big organizations.
That's a huge operational challenge. It usually requires really robust internal controls, clear accounting policies that interpret the standard for their specific business, and honestly, audit training for sales teams, contract managers, and finance folks. Auditors also spend a lot of time scrutinizing these judgments, as you can imagine. But stepping back, connecting this to the bigger picture, identifying these performance obligations correctly is fundamental. It's about truly understanding and breaking down what a company promises to deliver to its customers. When companies get this right, it leads to more accurate revenue recognition, which ultimately provides better information to investors and everyone else relying on those financial statements. It brings clarity.
So, thinking about this from the listener's perspective, what does this all mean for you? Maybe next time you buy a bundle, like a phone that comes with a service plan, or software that includes support. Pause for a second. Think about how many truly distinct promises, how many performance obligations might be hidden within that single price you paid. Does the way the company markets it match the underlying reality of what they're delivering? It kind of changes how you look at things, doesn't it?
Okay.
This has been really insightful, a great deep dive into a concept that's more complex than it first appears. And for those of you who want to solidify your understanding, maybe tackle some practice problems on this. Remember, all this material, plus those extra questions and detailed support, comes from farhatlectures.com. Whether you're deep in accounting studies, prepping for the CPA exam, or just genuinely curious about how business works, their resources are fantastic for diving even deeper. You can also find more info and connect with Professor Farhat on LinkedIn, Instagram, Facebook, Twitter, and Reddit. Lots of ways to connect. Until our next deep dive, keep learning, keep asking questions, and stay well informed.